next question is about capital adequacy ratio, which we just discussed. Okay, capital adequacy ratio is the amount that banks have to maintain in the form of their own funds. Okay, this is the important one. Okay, just we have seen here in a amount of banks own capital, own fund, to offset any loss that banks incur if the account holders fail to repay due. This is correct. Capital adequacy ratio is decided by each individual bank. Okay, so let's before that discuss CAR in detail and then we will solve the question. Okay, so capital adequacy ratio just we discuss. Now see, capital adequacy ratios decided by Basel III norms. Okay, Bank of International Settlement by BIS, and there are separate regulations by RBI. Okay, by BIS it is 8% and by RBI it is 9%. Now let's see the subcomponents. So there are two types. Okay, just we saw tier 1 capital and tier 2 capital, but in tier 1 capital also there is common equity tier 1 capital and additional tier 1 capital. Let's first discuss what is meant tier 1 capital and tier 2 capital. Remember, tier 1 capital is the core capital of bank. So it is core capital of bank which it uses for day-to-day function. So this is tier 1 capital. Now what is tier 2 capital? It is supplementary capital. Okay, in this way you can remember. Now see here, common equity tier 1 capital. Here is the difference, because Basel norm is 4.5% but RBI's norm is 5.5%. So please remember this point. Okay, if UPSC decides to ask a tougher question, then they may ask that common equity tier 1 capital of RBI is more than Basel norm, etc. And then additional tier 1 capital same 1.5%, 1.5%. Okay, you might have heard about 81 bonds. Those are issued by banks to fulfill this capital. Then comes minimum tier 2 capital. This is same for BSL and RBI. Then capital conservation buffer of 2.5%. Okay, and there is also another term known as cyclical capital conservation buffer of 2.5%. Okay, that is not in India, but it is applicable at global level. Okay, but that is apart. That is cyclical capital conservation buffer means whenever there is a period of growth, then something additional is kept aside. Okay, so this is CCB, minimum tier 2 and minimum tier 1 capital. So combine of all this becomes 10.5% of risk-weighted assets in case of Basel norm, and in case of RBI it becomes 11.5% of risk-weighted assets. So where is the difference? Because RBI's mandate for common equity tier 1 capital is 1% higher than that of Basel norms. So remember this. Now some important ratios. So first one is leverage ratio. So what is the difference between leverage ratio and capital adequacy ratio? Let's see it through formula. So in case of capital adequacy ratio, we have at numerator tier 1 capital plus tier 2 capital, and denominator we had risk weighted assets, and here what we have, total consolidated assets. So here is the difference. Now what is liquidity coverage ratio? Liquidity coverage ratio means it is now that banks are required to maintain high quality assets to maintain 30 days of net outgo. So in how much proportion banks should maintain these assets? This is liquidity coverage ratio. Just simply remember, liquidity coverage ratio is regarding high quality liquidity assets, okay, for 30 days. Now let's solve the question. Okay, first statement we saw that it is correct. capital adequacy ratio is decided by each individual bank. Is it correct? No. It is decided by at global level, Bank of International Settlement, and at domestic level, RBI decides it. Okay, so answer is 1 and 2. Okay, now let's see next question. Okay, this is regarding capital infusion in banks. So first statement is capital infusion into public sector banks by the government of India has steadily increased in last decade. So last decade means 10-year time period. This question was asked in 2018. Okay, now imagine from 2008 to 2018. Okay, there is very less possibility that something will consistently increasing in this volatile period. At least in some year there will be deep. Okay, so that's why this statement is incorrect, because consistently there is no rise. Okay, so remember, the government took various initiatives like recapitalization, bonds and etc. But consistent trend is not there. So remember this. Then second statement, to put the public sector banks in order, the merger of associate banks with present State Bank of India has been affected. Okay, so this is correct statement. This was in news in 2018. So only second statement is correct. So 2 only is the correct answer. Now let's see another important term which is in news, that is domestic systematically important bank. Okay, generally these are those banks which have their balance sheet which is 2% of GDP, at least 2% of GDP or more. Okay, these banks are those banks which are too big to fail. Means if these banks failed, then there will be repercussions in entire economy. Okay, so whole financial health will be disturbed. So hence it's the responsibility of the government to have additional checks on them. So these additional checks are in the form of additional reserve requirements. Okay, so if particular bank has certain capital adequacy ratio and certain norms of tier 1, tier 2 capital, then these banks have something different. So what is that ratio? I don't think it is important to know in such a minute detail, but if you want, then you can go through it. So just remember, these banks are too big to fail and requires additional regulation and 2% of GDP or more. Now what is important is, remember the bank name, which are DSIBs in India. So at number 1 we have obviously State Bank of India. State Bank of India. At second number we have HDFC Bank, and at third we have ICICI. Okay, because in exam you may be given a statement that there is not a single public sector bank which is DSIB, or you can be given a statement like there is not a single private bank which is a DSIB. So remember, there are both private and public sector banks as DSIB. So this is the important point. Now what is your job is to look for the minute details regarding the regulation, because I have told you that no need to look at it, but what if UPSC decides to ask you? So please have a look once. Okay, so now the next question is regarding interest coverage ratio. Okay, so before solving the question, let's briefly understand about interest coverage ratio. Now interest coverage ratio is nothing but interest coverage ratio, ICR, is nothing but ratio of profits earned by company to the interest payment they are required to pay on their loans. So this is the definition of interest coverage ratio. Now let's see the statements. It helps in understanding, first statement, let's see, it helps in understanding the present risk of a firm that a bank is going to give loan to. Okay, so quite clear, because see, at the denominator we have interest payment, so clearly it shows how much risk is there, okay, regarding lending. And then second statement, it helps in evaluating the emerging risk of a firm that a bank is going to give loan to. See, both the first and second statements are almost similar in nature, so they have to be correct and they have to be incorrect at the same time. Now see the third statement. The higher a borrowing firm's level of interest coverage ratio, the worse is its ability to service its debt. Means if there is a higher interest coverage ratio, then there are less chances that the firm will pay the loan. Now let's decode this statement. Suppose interest coverage ratio is low. Means what? Numerator upon denominator. This denominator is large. Means what? Interest payment is more than profits. Okay, this is the first scenario. Now see the second scenario. If interest coverage ratio is high, so numerator upon denominator, this ratio is high, so numerator is large, so it means profits are more than interest payment. Now just think logically, which one is the scenario where the firm is in better position to pay the debt? So obviously second scenario, because here profits are more than the interest payment. So whenever there is a interest coverage ratio which is high, whenever there is a higher interest coverage ratio, then firm's ability to pay the debt is good. So this is incorrect statement. So element 3, and your answer is A, 1 and 2. Okay, you can pause the video and look at here. Say interest coverage ratio of profits of company to interest payment. Okay, interest payment means which company has to pay on its debt, not the interest payment that it going to receive. Okay, so whenever there is lower interest coverage ratio, means what? Interest payments are more than profit, so less ability to service its debt. Please understand it carefully. Whenever there is a higher interest coverage ratio, then company is in good position to service its debt. And whenever the interest payments of company are more than the profit, then these firms are known as zombie firms. Zombie firms. So A is the correct answer. Okay, now important question regarding urban cooperative banks, which is in news. Okay, so let's read the statement. With reference to urban cooperative bank, consider following. They are supervised and regulated by local boards set up by state bank. They can issue equity shares, and they were brought under purview of BR Act through amendment. Okay, so now read the first statement, that they are supervised and regulated by state government. So you must be aware with recent news. So in 2020, Banking Regulation Act was amended. Banking Regulation Act Amendment 2020. So as per this, a regulatory function, UCBs, okay, banking related regulation, banking related, this was under RBI, and management related functions are to be supervised by state government. Okay, to be precise, registrar of cooperatives. Okay, so first statement is incorrect. As soon as you eliminate the first statement, you get your answer. So remember, second and third statements are correct, because second is obvious, they can issue equity share, because you might have read this in regular newspaper, the particular UCB has raised so this much amount of money through shares and etc. Okay, so answer is 2 and 3. So here is additional information regarding urban cooperative banks. Okay, the first one is through Amendment Act of 2020, banking related functions are to be regulated by RBI, and management related functions are to be regulated by Registrar of Cooperatives. Now see the PSL targets for urban cooperative banks. What is the present target? 60% by 31st March 2024, and by 2025 they have to achieve 65%, and by 2026 they have to achieve 75%. Now this was recently in news, so remember this carefully. Okay, they are because question may ask that UCBs are required to give 75% of loans to priority sector. So this is incorrect, because as per current guidelines it is only up to 60%. And another important thing that you must remember is National Urban Cooperatives and Finance Development Corporation. This was recently set up body. This is the umbrella organization for UCBs. It was set up on the recommendations of Vishwanath Committee. The name of committee is not important for UPSC Prelims, but just remember it, Vishwanath Committee. Okay, this is like self-regulatory organization, SROs we say it. And the membership for this corporation is voluntary. Okay, you cannot force any UCBs through act or structure to join it. It is voluntary, but obviously for various benefits UCBs will join it. And this in a National Urban Cooperative Finance Development Corporation is registered as a non-profit, non-deposit taking NBFC with RBI. So remember this also. So these are important aspects about urban cooperative banks which were in news recently. Okay, and remember this also. These are which are primary agricultural credit societies, primary cooperative agriculture and development bank, and state cooperative agriculture and development banks. All these entities are not regulated by RBI. They are outside the purview of RBI. So who regulates them? So I want you to answer this question in comment box. Okay, so remember these are not regulated by RBI, because see here you have asked about supervision and regulation of UCBs. So UPSC may ask regarding primary agricultural credit societies, cooperative agriculture development bank, cooperative agriculture and development bank, okay, and other. So pay attention here and tell the answer in comment box. Okay, see this 2022 question. This is on Bank Board Bureau. Okay, just we discussed question regarding Bank Board Bureau. Okay, here in 2019 you can see how simple the question was. Chairman of public sector banks are selected by Bank Board Bureau. Now since it was asked in 2019, UPSC further asked the question on same theme, that is Bank Board Bureau. Now read the first statement. Bank Board Bureau, the governor of RBI is the chairman of Bank Board Bureau. This is incorrect, because government of RBI is not the chairman of Bank Board Bureau. Okay, its chairman is an independent one. So Bank Board Bureau recommends for selection of head of public sector bank. This is the function of Bank Board Bureau. Then Bank Board Bureau helps public sector banks in developing strategies for capitalizing plans. Yes, here also Bank Board Bureau helps. So answer is 2 and 3. Okay, as soon as you eliminate the first statement, you get your answer. Okay, but remember recently there was a case in Delhi High Court. And due to Delhi High Court judgment, this Bank Board Bureau has to be restructured into FSIB. So what is FSIB? Let's see it. Okay, government recast Bank Board Bureau into FSIB. Okay, government has transformed Bank Board Bureau, the headhunter of directors of state-owned banks and financial institutions, into Financial Services Institution Bureau. I'm making some amendments. Why? Because amendments were required at Delhi High Court in its order last year said BBB is not a competent body to select general managers and directors of state-owned general insurers. Okay, so remember this. It has been recasted as FSIB. Okay, so next question is on credit rating agency. So what is credit rating agency? All of you know that if you buy some electronic equipment, say fridge, and there are rating 4-star, 5-star, okay, 3-star, etc. It shows efficiency. So what credit rating agencies do? They assess the situation of borrower, okay, and they show the ability to pay back the loan. See here, CRA assesses reliance of issuer company regarding timely payment of principal and interest on debt. Remember, the rating is not regarding company, but rating is assigned to security or assignment. So particular bond, for example, it is BBB plus or AAA plus, etc. This is the function of credit rating agencies. Okay, and it is regulated by who regulates credit rating agencies? So remember, it is SEBI. Now read the statement. In India, credit rating agencies are regulated by Reserve Bank of India. So this is incorrect. And as soon as you eliminate first statement, you get your answer. There is 2 and 3 only. But now focus on second and third statement and understand what is the demand of UPSC. So what UPSC is checking? See, the rating agency, popularly known as ICRA, is a public limited company. So UPSC is checking whether you read newspaper regularly or not, because in newspapers most of the time this ICRA agency is mentioned. Then Brickwork Rating is an Indian credit rating agency. So here just UPSC is checking whether you are aware with credit rating agencies or not. So let's see the list of credit rating agencies. Here is a list. First one is CRISIL, which is in Mumbai. Then India Rating Research Private Limited, which is also in Mumbai. Then CARE, also in Mumbai. Then Brickwork, okay, which is in Bangalore, just we saw here. Then Acute Rating, Mumbai. Informerix Valuation Limited, Delhi, and ICRA Limited in Delhi. So these are the 7 credit rating agencies, and you may know the global credit rating agencies like Moody's, Fitch, etc. Okay, now next question. Which of the following term indicates a mechanism used by commercial banks for providing credit to government? Okay, cash credit ratio, no. Through this, government banks doesn't provide loans to government, so this is incorrect. Debt service obligation, whose debt? Okay, not clear, incorrect. Liquidity adjustment facility, no. Through this, banks avail some facilities from RBI. Okay, this is also incorrect. So SLR is the correct option. So all of you know that under SLR, banks are mandated to keep certain percent of deposits with themselves. Okay, for present it is roughly approximately 20% of NDTL, and this 20% they can keep in the form of cash, gold, government securities. This section, government securities, forms large portion of SLR. Okay, so through this, by purchasing these government securities, they are fulfilling their obligation of maintaining 20% of NDTL with themselves. But through this way, they are also providing loan to government by purchasing government securities. So, and the answer is D, that is statutory liquidity ratio. Now the last question is regarding SHG, that is self-help group. So read the first statement. See here, why you should be mains ready before giving prelim examination. This example, this question is a classic example of this. So we have GS2, governance, social justice section. There is a clear cut point of SHGs. Okay, so you must prepare mains thoroughly. Okay, if you have prepared for mains thoroughly before prelim, then you have clear cut advantage. Now read the first statement. The self-help group program was originally initiated by the State Bank of India by providing microcredit to financially deprived. Okay, so this is incorrect because this SHG bank linkage program is of NABARD, not State Bank of India. Okay, sorry, not SHG bank linkage, self-help group program. Okay, this was microcredit program was started by NABARD. In an SHG, all members of group take responsibility for loan that an individual member take. This is correct because this is the principle behind SHG. The regional rural banks and scheduled commercial banks support SHG. This is generic statement. Nothing wrong is here. So this is also correct. So only two statements are correct. So let's discuss some prelim pointers also regarding SHG. Okay, so remember here, first point, membership both men and women. Okay, many of the students are confusion that SHGs are only of women. Okay, more than 90% SHGs are of women. There are some men SHGs are also, and there are some special groups SHGs also, like elderly, disabled, and transgenders. Then the most important point, registration of SHG is not mandatory. Okay, so pay care attention. Okay, you may be given a statement that SHGs must register themselves, etc. So this is not mandatory, but registration is mandatory for a group of SHG at village level. Okay, or something if they have to avail some benefit of some government scheme, etc. That time registration will be obviously mandatory. But read the statement carefully. Okay, if there is a plain statement like registration is mandatory for SHG, then it is incorrect. Then another important point, loans to SHGs. Loans to SHGs are considered as part of priority sector lending. So what are PSL norms that we will discuss in next lecture. So loans to SHG are PSL. Okay, so this is the discussion regarding first part of banking PYQs. I hope you have understood all the points very well. If you have some doubts, then you can comment in the comment box. Please like and share the video. All the best for your examination. Hello friends, myself Saurabh Shirke. I welcome you to Loka and IAS Academy to Economy Insights series. In previous lecture, we have discussed PYQs related to finance and investment topic. In this lecture, we will see PYQs related to topic of banking. Since there are a lot of PYQs related to banking topic, we have divided all these PYQs in two parts. So in this video we are going to discuss first part, and in next video we will discuss second part. So second part will be mostly related to digital initiatives. Okay, so let's start the video. So first question is about teaser loan. Why is the offering of teaser loans by commercial banks a cause of economic concern? So before solving this, let's understand what is meant by teaser loans. So teaser loans are those loans where the initial rate of interest is low for certain time period, but after the expiry of this time period, interest rate increases, and generally during this time there are chances of default. So this is teaser loan. You can see here, a teaser loan can refer to any loan that offers teaser rate of interest. Okay, teaser loans are popular promotional product for loan issuers. So teaser loan is a loan that offers lower interest for a fixed amount of time as a purchase incentive. And common teaser loans include credit cards with low introductory offers and adjustable rate mortgages. Borrowers must be aware that rates will apply after a teaser rate expire. These are features of teaser loan. So let's see it. The teaser loans are considered to be an aspect of subprime lending, and banks may be exposed to risk of defaulters in future. This is the exact risk due to teaser loans. This is correct. In India, teaser loans are mostly given to inexperienced entrepreneurs who set up manufacturing or export units. This is vague statement, so this is incorrect. So this is not the purpose for which teaser loans are given. Now, even if you do not have any idea regarding teaser loans, but in exam hall you are in such a situation that you have attempted very less questions and you have to attempt this. So at that time, what you would do? Let's understand the tone of the question. Why is the offering of teaser loans a cause of economic concern? So concern, so negative tone of MCQ. So go with this tone. So you can see the first statement also negative in tone. So you can take a calculated risk. But remember, MCQs you have to solve based upon knowledge. So what I told you, you have to take this risk, calculated risk only in certain time period, in a certain difficult time. Okay, now question upon liquidity. 4 options are given and we have to arrange this option in decreasing order of liquidity. So see here, so obviously it's clear that currency will be most liquid. Currency is the most liquid. So first will be 4. Okay, then saving deposits, time deposits and demand deposits. So remember, time deposit will come last. 2. So after currency, which one will come between 1 and 3? So demand deposit. This will be more liquid. So 1. So only remains third. So 4, 1, 3, 2 is the correct option. Okay, so which one is D? Okay, so fourth one, currency most liquid, then demand deposit, then saving, and then time. Okay, when you know that 4 will be the first option, then you will eliminate A and C. Again, when you will know that 1, that is 2, time deposits are less liquid among the given option, then you will eliminate B and directly come with answer D. So in this way you have to solve this question. But this was asked in 2013. Now UPSC will increase the difficulty level. You must be ready with major concepts related to money supply, and your 12th NCRT in third topic of money and banking, there are various indicators like M0, M1, M2, M3 and M4. So you must prepare them, okay, and not just understand the meaning of them, but also how liquidity reduces or increases, okay, from one indicator to other indicator. So let's discuss them. Okay, so money supply indicators M0, M1, M2, M3 and M4. So M0 is high powered money, or also known as monetary base, and M0 includes currency in circulation plus bankers deposits with RBI. Then comes M1. So M1 is currency with public and net demand deposits with bank. Then comes M2, which contains M1 plus saving deposits with post office. Then comes M3 with M1 and net time deposits of commercial banks. And at last we have M4, that is M3 plus total deposits of post office. But what you have to remember, see, M1 is in easy, currency with public and net demand deposit. For M2 and M3 we have M1 as common, and then we have the saving deposits and net time deposit. But for M4 we have M3, not M1. And you can see here M1 there is currency and then demand deposit. So this is most liquid. And when you go from M1 to M2 to M3 to M4, in M3 there are total deposits of post office, and also M3 which includes time deposits. So this is least liquid. So liquidity is reducing from M1 to M4. So this you must understand. Okay, liquidity is reducing from M1 to M4. M1 is the most liquid and M4 is the least liquid. Now you can see here M1, M0 to M4. All these indicators definition as per your class 12 NCERT. But RBI has different methodology. Okay, so let's see that. So new monetary aggregates. So this is as per Reserve Bank of India. How RBI calculates it? So see, NM0. Okay, high powered money or monetary base. This is same currency in circulation plus bankers deposit to RBI. Then NM1. This is also same with respect to M1, currency with public and net deposit with bank. What is different is NM2 and NM3. That's why I have written it in blue ink. Now see here, NM2 includes NM1 and certificate of deposits and term deposits less than 1 year. Okay, and NM2, NM3 includes NM2 plus term deposits more than 1 year and call term funding money from non-bank such as NABARD. This is the crucial difference you must understand. Okay, so let's see it comparatively. So M0 and M0 same, M1 and M1 same. The difference is here. In case of M2, there is M1 plus saving deposits with post. But in case of NM2, it is NM1 plus certificate of deposits and term deposits less than 1 year. And NM3, M1 plus net time deposits with commercial bank. And in case of NM3, is NM2 plus term deposits for more than 1 year called term money. Now at initial stage you might find it difficult to remember all this. Believe me, read it frequently, couple of times a day for 4 to 5 days, and you will understand these terms. Okay, remember it comparatively. Okay, map it. Okay, you can take the screenshot of this page. Sorry, you can pause the video and take the screenshot and note down the things. Okay, and remember here is M4 but there is no NM4. So if you face question regarding these monetary aggregates, then read the question carefully. If question has specifically asked about RBI's monetary aggregates, then solve it accordingly. If question hasn't asked anything, then we would suggest go through the NCERT. Okay, because these are mentioned in most of the places. Okay, but final call is yours. Okay, so decide which aggregates to remember. Okay, so this is regarding money supply. Okay, now next question is regarding core banking solution. Here also eliminate the vague and illogical statements. Okay, so even if you do not know about what is meant by core banking solution, then also you can easily attempt the question. Okay, so read the first statement. It is a networking of a bank's branches which enables customers to operate their bank accounts from any branch of the bank on its network regardless of where they open their account. So this sounds very logical and correct because we are experiencing it in our day-to-day life. Okay, but don't mark anything, just read the next statement. It is an effort to increase RBI's control over commercial banks through computerization. Okay, vague and illogical statement. Eliminate this. Third, it is a detailed procedure by which a bank with huge non-performing assets is taken over by another bank. Okay, just remember your notes. Have you gone through any such thing? Okay, if you are a serious aspirant, you have studied well and if you do not remember such thing, then mark it as incorrect. So you are only left with first option, that is one only, and that is the precise meaning of core banking solution. Okay, suppose A has bank account in Pune, in Bank of Maharashtra Shivajinagar branch. Then earlier what is to happen, he has to do all these transaction etc. from this bank branch only, but now due to CBS you can perform this transaction and either other activities to any bank branch in entire country. They all are connected. Okay, so A is the correct answer. Now next question. Okay, which one of the following links all ATMs in India? Okay, so another simple question. So answer is NPCA, that is National Payment Corporation of India. National Payment Corporation of India has various products. One of them is National Financial Switch. Through this product, they manage the ATM network connection in entire country. Okay, remember there are various products of NPCI. So those products we will discuss in a next video. Focus on here also, National Security Depository Limited. So what is mean by depositories? Okay, so that we will discuss, but before we will discuss the next question. Okay, that is chairman of public sector banks are selected by. Okay, so that chairmen are selected by Bank Board of Bureau. Read the question carefully. Question hasn't asked appointed by. Question has asked selected by. Those they are selected by Bank Board Bureau. Now whenever UPSC has asked question on certain theme, then you must search about that in detail, because I will show you in one of the upcoming question how they have expanded this theme of Bank Board Bureau. This was asked in 2019, and how in 2022 they ask a advanced question on it. Okay, so let's see this NPCI first. Okay, so NPCI, what is NPCI? NPCI is an initiative of Reserve Bank of India, Indian Banks Association. It is a not-for-profit under registered as not-for-profit under Companies Act. Okay, and these are the 10 promoters banks of NPCI. You can read about NPCI here, and there are various products of NPCI as I told you. So some of them are these UPI, IMPS, RuPay, AEPS means Aadhaar enabled payment system. So more information regarding these products we will discuss in tomorrow's video, where our focus is mainly on digital initiatives. So this is regarding NPCI. Now focus on this option, National Securities Depository Limited. So what is depositories? So remember, depositories hold securities in electronic form for investors. Okay, so NSDL and CDSL, we have NSDL and CDSL are the only registered depositories in India. They ensure smooth transfer of ownership of securities between buyers and sellers. Okay, now important points regarding NSDL and CDSL. So NSDL established in August 1996 and CDSL in 1999. Okay, so remembering exact year is not important, but what you should remember is NSDL is established before CDSL. Now backed by. So NSDL is backed by National Stock Exchange and CDSL backed by Bombay Stock Exchange. So remember NSDL N, NSE N. Now currently only two depositories, this we discuss. See the number of participants. Okay, NSDL has 277 registered depository participants and CDSL has 612. So CDSL has both. Okay, so understand the meaning of depositories. So depositories, they store your shares and etc. all things electronically, because when there were not depositories, the transactions used to be physical transaction through paper based system. So lot of inconvenience over there. Okay, and a lot of frauds used to happen then. So this is regarding NSDL and CDSL. Okay, now important question regarding merchant discount rate. Okay, so this question was asked in 2018. This is relatively simple question. Question has just asked what is the meaning of merchant discount rate. Okay, so merchant discount rate, correct option is C. That is the charge to a merchant by bank for accepting payments from his customers through bank's debit card. But merely knowing the option is not enough. You need to understand the mechanism, so you can remember this clearly. And if any question is asked on MDR, then you can solve it easily. So let's understand MDR. Suppose you are person A and you have debit card of Bank of Maharashtra and you purchase something from merchant. Okay, so you will, suppose you have purchased a shirt, so you will pay him through your debit card, and through point of sale machine merchants banks will accept it. Suppose his bank is State Bank of India. Then for accepting the payment, State Bank of India will charge something from merchant, and that is known as merchant discount rate, MDR. This is decided by Reserve Bank of India. Generally 0.40 to 0.95% of transaction value. Okay, so remember this. And this MDR will be deposited into merchant's bank. But remember, merchant's bank will not have the entire MDR. That will be divided between customer's bank, merchant's bank, and payment gateway. Okay, let me show you it clearly. MDR will be divided into customer bank, customer's bank, merchant's bank, and payment gateway. Means network of card. For example, Visa, RuPay, and etc. That is payment gateway. Now, how this MDR should be divided is decided by payment gateway, and the amount received by customer's bank is known as interchange fee. Don't confuse it with interchange fee of ATM. Okay, in ATM also we have interchange fee. Suppose you have ATM of SBI and you are withdrawing money from say Kotak Bank, then SBI will pay interchange fee to Kotak Bank. So interchange fee has two meaning. So focus on situation which is there and accordingly decide its meaning. So this is regarding MDR. So here the mechanism of MDR, which I have just explained it to you. Okay, customer will purchase a shirt through point of sale machine payment. Shopkeeper will receive the amount. Okay, MDR payment deposited in customer's bank, and who will decide the MDR? Reserve Bank of India. 0.40 to 0.95% of transaction. And focus here. This MDR will be divided between customers bank, shopkeepers bank and payment gateway. And how it should be divided, that would be decided by payment gateway. Now important prelim pointers regarding MDR. Okay, MDR is decided by RBI. MDR is divided between customers bank. Okay, that we have seen. Also we have seen interchange fee. Proportion of MDR that will be shared with customers bank. This is decided by payment gateway. Now crucial point from your prelim, there is a zero MDR on RuPay debit card. Now you may think, if there is a zero MDR on RuPay credit card, then why will bank issue their cards in RuPay? Because by issuing RuPay they are getting zero MDR. If they issue the same debit card in say Visa, then they will get certain MDR. So remember, central government has assured the banks that they will be compensated for the zero MDR. So remember this. This is the concept of MDR. But now there is a important current news regarding MDR, that is MDR on UPI transaction. Okay, so focus here. In this case, the payment was through debit card, but the same payment can I also made through UPI transaction. So if I paid through UPI, then what will be scenario? Let's understand. Okay, when MDR on UPI transaction. So before understanding MDR on UPI transaction, let's understand one key term, that is prepaid instruments. Okay, all of you know that what is meant by prepaid instruments. Okay, like Amazon Pay, Ola Money, where we deposit money through say card, UPI, and then use that money through PPI, Ola Money or Amazon Pay, etc. So when there will be transaction through PPI, then only there will be 1.1% of merchant discount rate from 1st April. Now let's discuss various payment methods. If there is a UPI payment from bank account, then there will be no MDR. UPI payment from prepaid instrument, but that value is less than 2000 rupees, then also there will be no MDR. But if there is a UPI payment from PPI whose value is more than rupees 2000, then there will be MDR, which is 1.1% of transaction. Okay, so focus here, have a look and read all this carefully. Especially focus here, not on all PPI transaction, but only those transactions which are more than 2000 rupees. Okay, now a easy question regarding assets and liabilities of commercial bank. Now you can see here, which among the following is not included in the assets of commercial banks. Okay, advances, loans are obviously assets of bank. Investments are also assets of banks. Money at call and short notice given to other banks also asset. But the deposit is not an asset, it is a liability for bank. So they have to return the deposits of customers. So this can't be asset. So this is liability, and this is based on your class 12th macroeconomics NCERT. Because since UPSC has asked about assets and liability of commercial bank, now your focus should be on Reserve Bank of India also. So you can see here sample balance sheet of RBI. So what are assets of RBI? Gold, foreign exchange, government securities, and loan to commercial banks. What are liabilities? Currency held with public, vault cash, and deposits of commercial banks with RBI. So focus here. Okay, so here you can see liability, deposits, option number B. Okay, now another important concept of Basel Accord. Okay, Basel 3. Let's see this question carefully. This was asked in I think 2013 or 14. Question asked, Basel Accord, often seen in news, 6-2. Okay, the question need not need not you to know the exact details of Basel Accord. But if you know just one thing, that Basel Accords are regarding banking regulation, then also you will solve this question easily, because read each and every option. The first option says regarding national strategies for conservation and sustainable biological diversity. Is anything regarding bank mentioned here? No. So eliminate this straight away. Read third option. It is about greenhouse gas. Eliminate. Fourth option regarding transfer of technology from developed to developing countries. Eliminate. Only there is one option, that is B. It says improve banking sector's ability to deal with financial and economic stress and improve risk management. So B is the correct answer. Okay, but there is very less possibility that UPSC will ask such simple question now. So let's understand regarding Basel Accord. So basics of Basel Accord. Basel norms, you can also say. So these are set up by Bank of International Settlement, based in Brussels. Okay, so what are these norms? Under these norms, what bank has to do? Bank has to first identify risk weighted assets, assign them percentage. Now, as per the risk weighted assets, bank has to keep certain percentage of their own capital aside, so that they can absorb the risk due to bad assets. Okay, for example, let's understand this through an example. Bank provides loans to various entities. Government. Generally, government loan given to government is risk free, because government can print money even if government do not have anything. Government can print the money and pay back to bank. Suppose bank has given loan to corporate. Suppose there is a risk of 20%. Suppose a collateral free loan is given to farmer. There is more risk, say 50%. Now suppose bank, second example, bank has given loan of ₹100 and 20% there is a risk. So bank is sure that 80 rupees will be received, but 20 rupees are risk weighted assets. So on this risk weighted asset, bank will set aside 8% of 20, that is rupees 1.6 aside. So this is capital adequacy ratio, nothing but. So let's see it. See here, capital adequacy ratio. What is meant by capital adequacy ratio? Ratio of tier 1 capital plus tier 2 capital to risk weighted assets. Now one question might come to your mind, that how this percentage is calculated. So that is out of scope of our syllabus. Okay, those who are studying finance at advanced level need to know that. We don't need to know this much detail. So just remember that banks has to keep their own money, okay, not depositors' money. Okay, tier 1 capital plus tier 2 capital to risk weighted assets. So capital adequacy ratio ensures enough amount of bank's own capital to manage risk arising from bad assets. So capital adequacy ratio as per Basel norm, it is 8%, and Remember, RBI's CAR norms are higher, it is 9%. And this is the example which I explained you here. Okay, now what is the difference between capital adequacy ratio and reserve ratio? Let's understand this. In case of capital adequacy ratio, it's bank's own money, but in case of CRR and SLR, it is depositors' money. Okay, CAR is decided as per percentage of risk weighted asset, but CRR and SLR are decided as per percentage of deposits. CAR is fixed by, at a global level, fixed by BIS, and at India, in India, it is decided by RBI. And generally, they are same. Same means they do not change frequently, but CRR, SLR can be changed based upon circumstances. Obviously, this can also be changed, but most of the time they are fixed. They haven't been changed